Okay, the question actually asks you to prepare the accounts. Okay, so the first account is actually a motor vehicle account. I highlighted in orange. So actually whatever journal entries that has this motor vehicles account will be also highlighted in orange. Means you actually need to capture it into our accounts. Okay, so let's look at the first year, the journal entry. Okay, in 2005, 1st July, they actually bought a motor vehicle for 90,000. Okay, and they used cash at bank to buy it. Okay, so we have to capture this into our accounts. So how you do it, the date is this, and the particulars is because they use cash at bank to buy this motor vehicle. So you put cash at bank. Okay, debit 90,000 because it's an asset, and you have a 90,000 debit balance. And if you look at the first year, there isn't any more transactions about motor vehicles. We actually close it by bringing down the balance to balance BD for 1st July 2006. Okay, so this is actually year 2 already, the beginning of year 2. We bring forward balance brought down of our 90,000 debit. Okay, and in year 2, okay, 2007, 1st March, they actually bought another motor vehicle using cash at bank of 48,000. Okay, so you capture this into our onto this line, this entry. Okay, and note that because at first we have a balance of 90,000. Okay, we add the new vehicle of 48,000, you get 138,000 debit. Means your total motor vehicles asset, right, is worth 138,000 at cost price. Okay, and in year 2 there isn't any more motor vehicle journal entry, so we close it by actually bringing down your balance. Okay, so 1st July, which is the year 3 balance BD, you should have a balance of 138,000 debit. Okay, and if you look at year 3, there isn't any new vehicle bought. Okay, so it will stop there. Now we look at the next account, which is the next account, which is your depreciation of motor vehicle account. Okay, so if we actually look at the first year, 2006, we actually have these two entries, right? Depreciation. Okay, so if you have to debit depreciation 8,000, you actually have to account it here, 2006, June 30th. Okay, you debit 8,000. And what is the corresponding details is actually the accumulated depreciation. So you put that accumulated depreciation motor vehicle, and you have a balance of 8,000 for a depreciation account. And on 30th June, you also need to transfer into our profit and loss. Okay, so June 30th, profit and loss, you credit whatever that is balanced, which is 8,000, and you should have a zero balance. Okay, so as you know, depreciation account will always be zero at the end of the year. Why? Because all the depreciation amount will be transferred into profit and loss for each year at the end of the year. Okay, so now we look at year 2, 2007. It's the same. Okay, so we actually use but the amount is different at 9,875. Okay, so June 30th, accumulated depreciation 9,875. Then June 30th, you transfer into profit and loss. So you credit 9,875 and you get a zero balance as usual. And same goes for 2008. Okay, with the amount of 13,625. Okay, moving on. So we have an accumulated depreciation account. Okay, so for our accumulated depreciation account, we look at where it's actually highlighted, accumulated depreciation. So they actually credit 8,000 into our accumulated depreciation account. The corresponding detail is actually depreciation on motor vehicles. Okay, and you have a credit balance of 8,000 for the first year. What about the second year? Okay, so for the second year, you need to have a balance BD also. So you bring down this balance of 8,000 into the next year, 1st July, next accounting year. Okay, and then 2007, okay, 30th June, which is the financial year end for the second year, okay, you need to calculate the depreciation, accumulated depreciation again. Okay, so basically it's a depreciation of 9,875. You actually have to credit this accumulated depreciation into here. Okay, and what is the balance? It's actually 17,875. Why? Because you have an existing balance of 8,000 credit, and you credit another 9,875 to account for the depreciation for the second year. Okay, so if you add both up, you should have this. So as the name suggests, accumulated depreciation. So it's like depreciation accumulating from year 1 and year 2. So year 1 depreciation, you add with the year 2 depreciation, accumulated depreciation. Okay, and same goes for year 3, where you bring down your balance, brought down to on the 1st July, the first day of your third financial year, and you bring down a balance of 17,875 credit balance. And the last day of your third financial year, 2008 June 30th, okay, you have another depreciation. You have another depreciation of 13,625. So you continue accumulating that. Okay, so it's actually your balance, beginning balance of 17,875. You add up, okay, your third year depreciation. So the total depreciation you have for you accumulated over the 3 years is actually 31,500. And so if it is the fourth year, July the 1st, okay, you should have a beginning balance of 31,500. Okay, so this is how you do up accounts, how you actually transfer the accounts and present it in our income statement and our balance sheet. Okay, I will show it in your next video.